Good afternoon, everyone. Thanks very much for staying with us. So we are starting our next session, which is focusing on the financial and commodity markets. The session will be chaired by Ross Loon from Department of International Trade. Ross has been a mining specialist working specifically in the projects with the projects in Central and Eastern Europe. Ross will have a challenge of handling lots of presentations and also Q&As at the end. If you're viewing us live, please type all your messages via the chat, which is located in the program part on the website. I will mute my microphones if you have any questions for speakers which have not been answered during the live session, because we have time restrictions. We'll try to connect you to speakers if you're a viewer, you're not a registered delegate. Otherwise, you will be able to chat with speakers using your digital portal. Thank you very much, Ross.
Thank you, Arthur. I have my own challenge because some workmen have decided to make lots of noise in the road outside. So I'm going to be opening and closing the window to try and keep cool. But anyway, I'm very pleased to be here, and I'm pleased to have such an illustrious panel with us today discussing mining finance, particularly for Central and Eastern Europe. We can start off with a series of presentations, and then we'll move into more of a discussion format. So without further ado, so that we've got lots of time, I'm going to hand straight over to Benjamin Jones from CRU, who's going to be looking at the implications of COVID on the commodity markets.
Good afternoon. It's a pleasure to be here and to participate in this virtual conference. My name is Benjamin Jones, and I'm a senior manager at CRU Group within its consulting division. It's my pleasure this afternoon to talk to you on the topic of COVID-19 and its implications for the mine commodity markets. I'll be talking about the impacts to date and also the potential implications for the future. And I will be encouraging us all to think about the potential for serious structural change in the market as a result of the COVID cycle, and generally discourage thinking around reversion to historical norms, which is enshrined in a lot of the debates around U, V, L, W-shaped recoveries and the like. Okay, so turning to demand, CRU's projections are for a demand collapse of between 5 and 10% across most metals markets, centered on consumer durables, transport, automotives, and other investment-related goods. But I think an important facet here is that it's not all about demand. This isn't just a macro shock. This is a massive health pandemic, and it's also impacted the supply chain. So mining supply chains are long and complex, as many of you very well know. And as a result, many of the downstream segments in particular have been quite heavily impacted. So if we're thinking about steel, for example, our analysis suggests that around a quarter of hot metal capacity has been disrupted due to the COVID-19 outbreak, and there's been idling in the CIS region. NLMK, Severstal, and others have idled or reduced their operating rates. But in particular, it's Europe that's had the most significant impacts. And for exporters in the region targeting Europe, this is obviously a really important issue. Turning to copper, for example, while there have been outages at Kazmin's ISC operation, we also see most of the impacts on the upstream copper market in Peru in particular as a result of these rolling lockdowns from the government, which have been instituted since March. In the smelting sector, the impacts have mostly been in China. Aluminium is quite a contrasting story. On the supply side, we see a return to growth through 2020 across all the major producing regions, with the exception of India, which is broadly flat, and Europe, which is contracting around 3.5% or so. So it's a very different picture in aluminium. It's a very pessimistic and gloomy view for prices, at least. Now, thinking about the future, perhaps it's worth initially taking a retrospective look at past cycles, in particular past global recessions. I think the first point to make here is that significant structural shocks really do change markets. They fundamentally affect the way that the structure of demand and supply, the way technology is adopted, the form of competitiveness, and public policy really drives a lot of those changes as well. So it's important to keep an eye on the form of the public policy response and what that might mean for the mineral markets. Now, a second message is really that these shocks are quite idiosyncratic in their impacts on the market, and that's indicated by the panel on the left, which looks at the structure of demand, supply, and intensity of use, for example, across a series of shocks pertaining to copper, aluminium, and iron ore. So there's a lot of information there, which I won't go through now, but if you look at the 2008 cycle, for example, you just see that the intensity of use really ramped up after the cycle, and that's as a function of the scale, but also the mineral intensity of some of the fiscal expansion, some of the fiscal spending, in particular in China. If you look at the 2015 cycle, so not a global recession, but certainly a major down cycle for the commodities industries, this time supply really distinguished itself in being slower to recover. So I think the message here is that shocks really matter. They really have the potential to restructure markets, but they're idiosyncratic in their nature. And that means that really the only way forward in thinking about what the future might hold is to take a scenario-based approach and to risk your business against that. So this is an example of some scenario analysis that we've done in CRU Consulting in recent months on behalf of a number of clients. Here, we're trying to think about the way the future might evolve as a function of broadly speaking, two major variables. One is the persistence and seriousness of the underlying epidemiology, whether it's a short-term or a very extended set of health issues. And the second is really in terms of the effectiveness of the government response and the industrial supply chains in adapting to evolving health risks. So the scenarios here are termed bump in the road, managed adjustment, and disorderly transition. So bump in the road, as you might guess, is one in which the health risks are short-term and public policy and industrial supply chains adapt quite effectively, in which case it's close to a V-shaped recovery in that kind of that lettering of cycles. Managed adjustment and disorderly transition are much more serious and persistent health risks. But they distinguish between one another in terms of the effectiveness of the response. So in disorderly transition, which is, I think, my hunch where we're headed to, is one in which the response is less effective in some countries, in particular because they struggle to afford the cost of the lockdowns and the social safety nets that are provided, or they're unable to implement some of the technological solutions that are required to maintain our economic activities in a more efficient way. So one of the things we do for clients is to think through some of the strategic implications of some of these scenarios. That's really the business of trying to adapt and look through the noise and try and anticipate some of these structural changes, which is important for achieving commercial success in these kind of times of real uncertainty. So it's a very wordy slide. I don't expect anyone to read it now. I guess these slides will be circulated after the conference, I'm sure. I guess the two messages here are, one is the right strategy depends on the scenario and the world we're evolving into. So it's really, really important to think through what are the key leading indicators around these scenarios, so that you can start to anticipate and position yourself for the right world, if you like. I guess the second point really is that across both managed adaptation and disorderly transition, disorderly adjustment, we find the real potential for shifting patterns of competitive advantage, right? New technologies, new policies, new behavioral responses that result in shifting markets. Now, we've been doing a lot of work around this. So this next slide is just a simple example of that. So we think that, particularly in disorderly transition, for example, that tariffs are increasingly likely to create new competitive space. And in Europe, if we're thinking about steel into Europe, for example, there may be a new basis for tariff policy, which is more focused around environment than traditional anti-dumping or protectionism. So we've been doing a lot of work thinking about carbon border tariffs, which is a potential way that's being worked on by the Commission right now to protect the industry while it begins to prepare to invest out of its very carbon intensive production routes that it's currently engaged with. Now, our analysis finds that this could have very, very material impacts, not just for prices and margins, both within and without the European Union, but also for the volumes as well. So certainly, if this scenario would certainly suggest keeping a very close eye on these kind of issues. Our leading indicators in terms of the impact assessment work that's being undertaken by the European Commission as of now would certainly suggest that this is one to keep a close eye on. So just, I guess, wrapping up, more than happy to take questions around any number of these issues. I guess summary messages are the following. COVID-19 has had a really big impact on the market. It's not just a demand story here. While we've seen demand destruction on the order of 5 or 10%, it's also on the supply side. Markets like steel in particular are really heavily impacted on the supply side, either through the physical risks or through the strategic responses to the down cycle in prices. Looking ahead, we personally see a lot of opportunities for fundamental structural changes. Those kind of risks are not reflected in the sort of mainstream discussion around, VUL, W-shaped recoveries and the like. They ignore the potential for fundamental changes. Those fundamental changes have been observed in past structural shocks of this nature, and really we would encourage you to think very, very carefully about the potential worlds that you could be evolving into as a basis for risking your business and seeking commercial advantage. Thank you.
Great. Thank you, Ben. That was a really good start, and interesting to understand your different scenarios and to have an economist to start our finance session. And now we're going over to a different theme. So we're looking at new energy vehicles and the impact on EV metals and the impact of EVs on different metals. And we're very pleased to have dialing in from Brooklyn, Jeff Christian from CPM. So over to you, Jeff.
Okay. I think I have control here. Let me see how quickly I can go. As Ross said, then Ross, thank you, and thank you to MINEX, and thank you to all who are listening. Hopefully the technology is simple enough for me to keep track of. I'm going to be talking about new energy vehicles and electric vehicles and their impact on metals markets. And we use the term new energy vehicles because we're something of skeptics about electric vehicles. Let me just sort of see how I figure, how do I move this here? I go to here. Just to let you know a little bit of background, I wrote a book on electric vehicles and hybrid vehicles in 1979. I've been studying all energy markets, alternative energy markets, and metals and other commodities since university in the early to mid 70s. and followed a lot of alternative energy technologies. The theme of my 1979 collector's item book basically was that electric vehicles were decades away from being commercially viable, and that I was going to get into metals research more wholeheartedly. So I went to J-Air and then ran their research department, which became the Quantities Research Group of Goldman Sachs. And then we spun off in 1986. Throughout that time, we continued to look at energy and energy technologies. So we've got a fair bit of history and depth of a background. These are the conclusions, so that if we run out of time, I just cut off the charts. These are the things that I'm going to be showing you charts to support. The automotive propulsion technology is changing. It's a long-term change. It's not going to come fast. And when I say fast, it's not the 10 years. But the future of motive propulsion technology is far from clear. There are a lot of people who think it's going to be electric vehicles, and that think that the electric vehicles are going to come in very quickly, that they'll have a third of the market by the end of the current decade, by 2030. It's probably not going to be that fast. Which technology ultimately wins is not clear. We would not be surprised to see electric vehicles as a transition technology that takes market share for the next 10, 20, 30 years, but then ultimately loses market share to something else coming down the road. Possibly hydrogen engines, possibly some other technologies that we really don't know. But which technology wins is far from clear, and which metals are used in that technology are far from clear, and the speed at which it all comes to pass and what volumes of metals is not clear. One of the things that is clear to us is that that gasoline and diesel vehicles are going to be around for decades to come, and that has important positive implications for platinum, palladium, and rhodium, because we're going to be burning petroleum distillates for the foreseeable future, and that's going to require those things. So I think that those metals are somewhat underappreciated at this point by people who think that the transition to electric vehicles is going to come much faster. I'll show you our projections in a second for the automotive propulsion mix over the next 30 years to 2050. Our projections are a much slower projection than some of the things that you see in other places. There are limitations. There's not enough electricity for electric cars. The electricity supply grid in most countries, with the possible exception of Germany, is insufficient to handle that electricity, even if the supply and the demand were there. There is a tremendous amount of capital requirements by smaller companies, many of which are private, or smaller public companies that make the components for the auto companies. These guys need to spend tens of billions of dollars making factories to make everything from manganese sulfate and cobalt sulfate, high purity chemicals, motors, controllers, and other systems. They have no support from the auto industry because which technology they need is not clear. So the auto industry will say, well, we think we don't need 1 million or 2 million motors for electric vehicles. We think we're going to need 30 or 40 or 50 if we're going to take 30 or 40 or 50 million vehicles market share in the coming future. However, we're not sure which motors we need. We're not sure that we're going to need motors. It could be some other technology that we use. So we need you to build these factories now with capital that you don't have, although we have. You don't have access to capital being a smaller company. We have that access, but we're not going to supply you any capital support. We're not going to supply you supply agreements. You're pretty much on your own, and we will make no commitments that we're actually going to buy that stuff. So there are a lot of logistical limitations to a rapid transition to any new technology. Lithium battery demand for lithium, manganese, and cobalt will continue to shift. We've already seen over the last 2 or 3 years the projected cobalt use in electric vehicles fall by 33%. And another 50% cut from the currently reduced projected level is projected for the next few years. So within a 4-year period of time, before you even get into the business of producing tens of millions of electric cars, you've seen the demand for cobalt will have been reduced by about 2/3. It's not clear what's going on. Nickel and copper are much more interesting. Platinum group metals, as I said, are going to be good. If you're going to use electric vehicles, you're going to need electricity. Solar and wind and hydro can only do so much. So you're probably talking about nuclear power and you're talking about uranium. And then there's lithium and cobalt. They rose on the hype. They fell on reality. People are starting to look at the fact that if you start using a lot of lithium-ion batteries in vehicles and in electrical storage systems, you're going to have a lot of lithium-ion batteries to recycle, and you're going to start recovering that lithium. Lithium recycling has been absent from every other projection except CPM groups for future lithium supply and demand, at least until a couple of years ago. So there are a lot of issues that are creating uncertainty in this. These are our projections for propulsion technology mix over the next 30 years. On the left-hand side is the millions of vehicles. On the right-hand side is the market share. And you can see for the next 10 years, you're starting to see electric vehicles and hybrid vehicles take a little bit of market share. Fuel cell vehicles hardly ever show up. And over the next 10 years, it's a very small market share, less than 10%. And going out to 2050, you still have about 70% of the vehicles burning petroleum, either as gasoline vehicles, diesel vehicles, or hybrid electric vehicles. So it's going to be a much slower transition than a lot of metals people think it's going to be. Also, it's not just metals, it's hydrogen. We've been working with a company looking at liquid organic hydrogen carriers, which is a safe and cheap way to ship, store, and distribute hydrogen. Once you've done that, you can go with fuel cells or you can go with hydrogen engines. And there's also the stationary storage issues. Which metals are going to be used? The cell phones, the laptops, they use lithium and cobalt. Power tools, they use lithium and manganese. We're seeing in electric vehicles that you could use lithium, cobalt, nickel, manganese, aluminum, iron, phosphorus. As I said earlier, you've already seen the lithium, nickel, cobalt, manganese vehicles reduce their cobalt demand by 1/3. And a lot of that has gone, some of it's gone into nickel sulfate, but most of it's gone into manganese sulfate. And manganese sulfate looks a lot more likely to have demand in the future than the cobalt sulfate. So we're much more positive on that than we are on other things. So just going through the graphics that support what I was talking about, the future of motive power, there's a hierarchy of uncertainties. What will be the future motive power? Will it be electric vehicles? If it's electric vehicles, will it be lithium batteries or something else? If it's lithium batteries, which technology? Because there are all sorts of lithium-ion battery technologies. Which metals are you going to use? Just looking at some of those issues. Gasoline, diesel, compressed natural gas, electric vehicles, hybrid vehicles, plug-in hybrids, fuel cells, hydrogen engines. I'm actually very interested in hydrogen engines. They are a fraction of the cost of fuel cells and electric vehicle power packs. And they also are less technically sophisticated than gasoline and diesel engines. And they cost about half of what a gasoline or diesel engine costs. And they were demonstrated to be viable around 2005, 2006. If you get into electric vehicles, which battery technology? Is it going to be a lithium-ion battery? Which lithium-ion battery? If it's going to be calcium-ion, Oxford University and other schools are looking at calcium-ion batteries, which completely changes the chemistry of those batteries. There's sodium, there's vanadium, there are all sorts of battery technologies that are starting to be researched or being researched and starting to emerge that could completely upset the mix of chemicals and metals that you need for those batteries. And then again, that's there. I think I've beaten that horse. Then there's the issue of electric vehicles not being as environmentally friendly as believed. They kick out a lot of carbon dioxide, both in the manufacturing of the batteries and actually in the recycling of the batteries. I was around in the early 1990s when the EU decided that diesel fuel, for some reason, was cleaner than gasoline. And they put in diesel fuel subsidies and diesel vehicle subsidies, and they browbeat the petroleum industry to spend hundreds of millions of dollars building diesel fuel capacity, only to come along a few years later and say, gee, that was a mistake. We're sorry. We're going to get rid of those subsidies and all of that capital that you deployed in changing your petroleum refining facilities really down the tube. You've got the same thing going on now. People are really bullish about electric vehicles. They're not zero emission vehicles. You're shifting the location of where that carbon dioxide is being produced, but you're not actually reducing the carbon dioxide emissions. These are our projections for metal use going forward on electric vehicles. We probably have half the lithium and half to a third of the lithium and half to a third of the cobalt. We have more magnesium than a lot of other people are saying. A little bit on fuel cells. Since I was in university, fuel cells were on the horizon to within 5-10 years, they would be using 300, 400, 500, 600,000 ounces of platinum a year. There are several problems with that. First, fuel cells haven't been technologically viable, and they still aren't. Second, they're not economically viable. An ICE engine burning diesel or petrol costs about $3,000 to make. A battery pack costs $8,000 to $10,000, depending on if you're buying a Nissan or a Tesla. A fuel cell stack costs about $30,000, and it's not as reliable. Those hydrogen engines I mentioned earlier, they're about $1,500. So they're not economically viable, they're not technologically viable, they're not being used. And additionally, most fuel cell manufacturers have found ways to engineer the platinum out of their fuel cells. So fuel cells probably are not a successful automotive technology for the future, and probably not a big savior of the platinum industry if the auto industry moves away from burning petroleum products. That said, fuel cells do have applications in small fleets, forklifts, airport fleets of vehicles, buses, where you have a fleet manager and you have places where you can be refueled by a technically proficient fleet manager. But they're probably going to continue to be a relatively small part of the market, and they could be blown away by an emerging technology. That's it. I will be around for questions. I'll be participating in the panel discussion later this afternoon for you. And I am always available by phone, email, Skype, and God knows how many other programs. Thank you.
Great. Thanks, Jeff. That was a very different approach to the one that we're used to on lithium and battery technology. So fascinating. And now, to change the mood completely, we're going to have an update on gold and silver from Florian Groom. Over to you, Florian.
Hello, everybody, and thank you very much for having me. My name is Florian Gromes. I'm the Managing Director of Midas Touch Consulting, and I want to give you a quick technical update on gold and silver. Just maybe, Ross, you can let me know if you can hear me, see me, and also see my mouse, my pointer. Okay, nobody's complaining, so I just continue. Please bear in mind, I have no clue about the future. I only cook with water like everybody else. You have to do your own due diligence. I want to start with the first chart. It's a macro chart. This is the total US weekly jobless claims, and you can see over the last 10 weeks, obviously, we all know this has been exploding. In America, there is now more than 40 million people without a job or having claimed jobless benefits. And the same thing is true for most of the other countries on this planet. So the situation in Europe is similar, in Australia, everywhere. Central bankers, in response to this, have expanded their balance sheets to unprecedented levels. You can see here the Fed balance sheet for the Federal Reserve in America. The same thing is happening in Europe for the ECB, and obviously all the other central bankers as well have expanded their balance sheets. So there's a massive amount of liquidity somehow being created out of nothing. And there is certainly a point to be made if you look at the stock markets being at where they are right now, that liquidity trumps everything at the moment, even though the real economy is in a dire shape in most countries or most sectors. And as a response from the market as well, you can see already, and this I think is important to be aware of, this is the price for beef, and it's up nearly 100% over the last few weeks. So this is a direct correlation, I believe, to supply and demand shocks, as well as the massive expansion of the balance sheets of all the central bankers on this planet. And if we put this all together, a quick summary of the macro picture, in my opinion, we've seen the largest stimulus by governments and central bankers in history. We have, which will lead or is already leading to a devaluation of all the fiat currencies in the world, which then, of course, creates a loss of confidence in the fiat money systems and in the systems itself. And more people, therefore, are looking for ways to preserve their wealth, which obviously cannot be stored in paper money systems. And due to that, you have seen a strong physical demand for gold, not only by smaller retail investors, but we've seen this trend already for a few years from central bankers who actually want to hedge themselves or have to hedge themselves somehow. And also we have seen a lot of ETF demand, gold ETF demand. And gold prices in basically all currencies are, or just recently reached new all-time highs only in US dollar. It's still lagging a bit. And we also have seen a disconnect between the paper gold price and the physical price for gold. If you remember, at the top of the Corona crisis 2 months ago, the spread between the spot and the futures price exploded and was trading at, I think, roughly $80 to $90. And there's still some disruptions. So if we now go to my first chart, it's a weekly chart for gold, and I quickly want to bring us all on the same page. So this is the last 10 years in gold, and you can see here on the left side, this is the all-time high at 1920 in 2011. After that, gold had a clear and strong corrective move down to 1,045 in December 2015. And since then, gold basically is on the way up again. However, and this is the first most important takeaway from that chart, you see these smaller red circles here. Gold has been running, I think, 6 times against this resistance level, 1315 to 1375. It failed many times. And this whole bottom building phase here took a few years, actually. And then finally, more or less a year ago, in May 2019, gold was able to finally break through that resistance zone. And since then, gold is on fire and in an uptrend. So gold has been already rising long before the Corona crisis started. And it just, on the larger scale or on the bigger picture, continues to rise. And as you can see as well, the next resistance level would be the $1,800 levels. And we're talking here spot market price. And the $18 resistance comes from these 3 tops from 2011 and 2012, where gold was not able to move higher anymore. So I use the same chart and want to show you 2 important trend channels that I believe are still in place or basically influencing the market at the moment. You have this dark green, more flat kind of uptrend channel, which is in place since the low in December 2015. And early this year in January, gold was able to break out of this trend channel, came quickly back down during the Corona meltdown, and now is clearly above this dark green channel. However, there's another light green channel, a little bit steeper channel in place since August 2018, which was the last important low in the gold market. And again, the gold bulls are trying to break out of this channel and move away to the upside, basically. So if they proceed here as well, you can no doubt about paint another parallel trend line, and then you would have targets somewhere up here. So this is the weekly chart. And if we move in a little bit further, we have the daily chart. This is basically since Christmas of last year. Most importantly, I marked here the pre-corona high, which was $1,703. And we already had a little intermediate top here at 1689 2 weeks earlier. And if we now look at the gold price at this moment at $710, you can make the point that basically gold didn't move too much over the last few months. Yes, we had a massive sell-off, a liquidation event in the market, like all other markets during the start of the corona crisis, but gold quickly recovered and basically is moving sideways now since mid of April, trying to break out. Yesterday, it still looked like the bulls could continue to move higher. Now, today, it looks like we will remain in the sideways kind of range for foreseeable more days and weeks. And but markets is already a little bit oversold on the daily chart, and you can see the blue line is the 50-day moving average, the red line is the 200-day moving average. There's a lot of support if the bears can make any progress here and get a little bit of a larger correction going. Gold is very well supported. This is the light green channel that you've seen on the weekly chart. This is the dark green channel. So these both trend lines are as well giving good support. I don't see gold moving much lower than 1650 is already a lot. Probably the worst case would be probably a pullback to the 200-day moving average. This is rising, so maybe somewhere here, and we're talking then 1600 maybe. I think much more won't be possible, but I will give you two clear scenarios at the end of my presentation. And for now, I also want to look quickly at silver. Silver has been lagging gold quite a lot. Actually, we had seen, and this is not on the chart here, last August, there was like 2 weeks when silver tried to catch up, and since then it moved sideways, and then this is the pre-corona high here. You didn't miss out anything. We had a nasty sell-off, a nasty crash, and basically silver fell to a 10-year low at 1160. And now it has started to recover, and over the last few weeks, basically it was pushing the whole sector higher, and it was kind of leading gold and the miners higher. And it has reached now 1850 yesterday, or 1835, the spot price for silver. And this is also a resistance level. So you can see this is the red line. This is the 200-day moving average, also good support. Maybe we are in a pullback here again within this kind of steep trend channel, but overall I expect silver to move to $21 over the next few weeks and months. I still miss the typical parabolic spike that you see in silver in every wave up, basically. And so silver remains bullish, and I think silver is actually one of the best inflationary hedges over the next 10 years. It is very undervalued if you look at the gold-silver ratio, and I think investment demand is slowly but surely kicking into the sector. Now, if we want to get a better idea of what's lying ahead for the next maybe 3 to 6 months, I like to always look at seasonality as well. And this is basically the average seasonal gold price over the last 52 years. And you can see that we are usually making an important high somewhere in February or March, and then are in this kind of like corrective period where you usually get a bottom in gold in the early summer, June, July, sometimes early August. That's where you usually find an important low in the gold market, and then a nice rally into August, September, and even October. That is the general picture that worked out very well last year. It could be that we are into something similar this year. However, this year is the US presidential election. So if we filter out all the years where there was no election and just focus on the election years, you get a little bit different type of average from a seasonal perspective, which
Sorry,
basically...
you've got about 1 minute left.
Sorry?
You've got about 1 minute left.
Okay. So the seasonal window during the presidential election years would be basically rather a bullish, topish kind of thing in June, July, and August, and then 2 down waves. So I wouldn't be surprised to see a weaker gold price this year, 2 to 3 months ahead of the election in early November. And I have to speed up. So my main scenario is that we are in a stagflationary bull market, a kind of cracker boom where nominal everything is rising, while in real terms, the currencies are just devaluated. That would mean gold probably will more or less, with pullbacks, but will more or less continue to move higher towards 1800, pull back again, then 1920 is the other target, the all-time highs. There I would expect a little bit larger pullback, and then probably next year breaking out to new all-time highs, and then rather quickly move into the mid-2000s. And the alternative, that would be the case if you believe that central bankers will not be able to print enough, or will somehow be forced to stop, or cannot continue with their policies. That would be more of a deflationary phase. That basically would mean everything, the real economy drags everything down, and gold in that case, in my case, would be basically working on a cup and handle kind of formation, probably still making it to 1800 over the next 2 years, a few weeks, and then running into a larger correction that could easily take 2 to 3 years. If this cup has taken 8 years in the making, this handle would at least take 2 or 3 years, and it should then correct all the way down to this former resistance zone, which is now support, the 1350 to 1375-ish range, and that would coincide with this uptrend line. And that would give you obviously a very good opportunity to buy into precious metals a few years from here, maybe two years into the future from here. But you're risking that you might be wrong, and we see scenario A. So I'm giving a 70% probability to scenario A and a 30% probability to scenario B. I hope I could help you a little bit, give some more clarity about the gold market, and thank you very much for your attention.
Thank you, Florian. So we need to speed up a bit, because if we all take that long, we won't have any time for questions. So I'm relying on Hugh we've got Hugh Williams from the EBRD, who's going to be talking about their investment criteria for new projects. Thanks.
Thank you, Roz. I will try and get through my allotted slot in less than 10 minutes. The short version for those who are interested is, yes, we are open for finance and our criteria have not changed. Sorry, I'm having a... thank you very much. Right, so first we'll talk about COVID-19. Then for those who don't know us, we'll talk a little bit about EBRD and our natural resources team within that. So what has struck me today about COVID is it doesn't seem to have had very much impact at all on the miners. You know, we've had Central Asian Metals talking about both their mines continue to operate. We've had Adriatic saying very small inconvenience on the drilling side. And Ben was talking about different scenarios, one of which was just a bump in the road. And that seems to be how the world is treating it at the moment. The S&P 500 is only down 5% this year, and the mining heavy ones, Toronto and Australia, are down 10%. This is not the end of civilization as we know it, which is what some of the press reports might have you thinking. But I think the longer term economic impact is yet to be fully understood. So from an EBRD point of view, we are an international finance institution. We provide around 10 billion euros of finance every year. And when the COVID hit, we instantly allocated 1 billion as available for existing clients who might have liquidity needs. And then that was rapidly scaled up to 4 billion. So that is a quick facility that we can help existing clients. We are still open for business on new deals, and we're seeing a lot of new facilities going out to support the financial institutions around our different countries. So for me, the question is, you know, what is the impact of COVID in terms of the future economics and the ability to do deals? And I think the obvious one is around site visits and verifying what's there. So of the 3 live deals that I'm currently working on, 2, we had the site visits before COVID lockdown, so they're not impacted. And in the 3rd case, we're trying to do this remotely, and it seems to be working reasonably well. You know, in a worst case scenario, we could perhaps defer DD until the end and make it a condition before we disperse, but we haven't had to go there yet, and I'm not sure we will, because the economies seem to be unlocking already. The second impact is on the mines themselves. And, you know, we've had very little impact in this part of the world so far. Clearly, some of the mines in South America have closed. And the biggest impact I've been able to find was Polyus's Olimpiada site in Russia had a COVID-related close. And broker reports estimate around $230 million of impact on EBITDA. But that's very much an outlier. Everything I'm hearing from everyone else is business is pretty much as usual. So for me, the big uncertainty if we're looking at doing deals is around what's the future economic impact? What is the impact on demand for products? And there, I think, you know, we need to think about the fact that governments are taking on a lot of debt in order to pay for these job protection schemes, to help bail out companies that have gone bust. So there may be a lot more government debt around and therefore less capacity to do the infrastructure projects, such as rolling out electricity grids for the EV vehicles. Moving on to EBRD, we were set up in '91. We are a AAA rated institution owned by 69 governments, and the majority of our shareholders in terms of the issued capital are EU institutions, EU governments, but every country we invest in is also a shareholder. And we have some others such as USA, Japan, China, India. We started off former Soviet Union, Eastern Europe, but over the years there's been some mission creep, and we now also cover Greece, Turkey, North Africa, Lebanon, Jordan. So this is the map of where we invest, and I agree it's somewhat niche. We're not currently looking for new investments in Russia, although it remains one of our countries of operation. On average, we do around 10 billion euros a year, and these are the sorts of countries that it's going into. So not that much in Eastern Europe, as you can see in the last year. Generally, about 80% is private sector, and most of that is debt. So the equity team, which is where I work, is a relatively small part of the business. Moving on to what are our investment criteria and what can we provide? The answer is we do debt and equity. And for the equity side, we typically have a $5 million minimum because this is quite a labor-intensive business. And we help and work very closely with the companies and spend a lot of time post-investment. So we felt that 5 million is the minimum. And generally, we don't like to have more than about 10% of the business. So we're looking for companies with a market cap over $50 million. On the debt side, the average deal side would be around 10, but we can go much smaller if we need to. Good example is in Mongolia last year, we did a convertible loan at $5 million. In terms of mining, the commodities we don't do are uranium, thermal coal, and oil. Most of our investments to date have been in things like gold and silver and copper and zinc and lead, but we're willing to talk to people about the battery metals, although we don't yet have any experience of them. This is the natural resources team. You can see that most years they do around 1 billion of that 10 billion. A lot of that is for things like gas pipeline infrastructure. So the actual metals and mining side is somewhat smaller than that. And they're mostly doing debt with a little bit of equity, a good geographical spread, and a lot of experience in the team. There's a cheat sheet showing some of the companies we've worked with, and we're very happy to add some more people to that list. In terms of the debt side, we aim to be like a commercial bank in terms of what we're charging. We're not trying to undercut the market or give money away. We generally only fund up to 1/3 of the total project cost. So we would need to find other people to help us finance deals. And I've already mentioned the equity side. There's a few contacts there if you want to follow up after this conference. I work in the equity team, but working with the natural resources guys, and the other 3 are all natural resources bankers who are happy to talk to you about debt or equity or both. I suggest, in the interest of time, we stop there. We do have some case studies that would give you a flavor for the sort of deals we've invested in. So gold in Mongolia, copper in Poland, and Kosovo, and so on and so forth. So back to you, Ros. Thanks very much.
Thanks, you. That was great. I think we've made up a little bit of time. So over to you, Ayuna. And Ayuna Nedcheva is from the London Stock Exchange, and she's going to be talking about the capital raisings that she's been seeing in Q1 during the COVID crisis. Thank you, Ayuna.
Right. So today I wanted to talk a little bit more about how the markets reacted to COVID-19, especially with regard to metals and mining industry. It is very easy to just project doom and gloom and just to say everything went down, but actually encouragingly now the markets and the data and statistics support the view that markets are recovering in a quite a stable way. And after the shock to the market that we've seen at the end of March, the trend is actually quite positive. So going to the first slide. So in terms of the equity markets performance globally, interestingly, the benchmarks that we typically use are indices such as FTSE 100, the 100 largest companies and most liquid companies in the UK, S&P 500, and so on. So we can see that after the decline at the end of March, they're now recovering quite well. And actually, in fact, if we look at the at how the FTSE 100, for example, performed, it's now largely going into the positive zone. So I would definitely say that when it crossed the 6,000 point threshold back up, it was very, very good for the markets. But what underpins all of that return to the positive area? And I think very, very importantly for us is to understand that the global capital markets have continued to provide much needed capital to companies that are already on the market. So we have seen a tremendous amount of activity by the listed issuers on our market, including metals and mining, that have raised follow-on capital throughout the first quarter, but also continued in April and May. Just in terms of the numbers, just to give you an idea, $6.3 billion US was raised in London through IPOs and follow-on offerings in the first quarter. Actually, it was probably it actually was the largest amount of capital raised throughout Europe that was happening in London, which is very encouraging for us. So that trend continued. So if we look up until actually 15th of May of 2020, actually over $7 billion US has now been raised, and I'm talking actually more broadly. So I'm talking companies from the industries and sectors that have done relatively well in this environment. And of course, we're talking about e-commerce, we're talking about food retailers, but also actually some technology companies, food delivery companies, and actually manufacturers, infrastructure businesses. So this has a very positive cascading effect on all across the range of sectors. However, of course, in industries like airlines, for example, that are most affected, we will need to wait a little bit longer to see how recovery happens there. So just to talk about mining specifically. So a few of my fellow panelists have mentioned some of the Russia, CIS, and European mining companies that some of them have been affected. Some of them, as the previous speaker said, actually barely noticed any difference. And companies like Central Asian Metals, looking strong, but also some of the listed issues, especially those that have gold in their portfolio, such as Polymetal, Polus, would be doing, of course, would be feeling more comfortable in terms of balance sheets than others. One example I wanted to give you is Adriatic Metals. It's a company that's listed in on the 12th of December last year, and you can see I just wanted to show the share price chart that it has declined around March and then started recovering quite significantly afterwards. That's a very good example, and obviously the main country of operation is Bosnia and Herzegovina. Another example that could be quite interesting to see is Pure Gold. So again, we've talked about gold today. This is a Canadian, also dual listed on TSX and in London. So again, working in partnership with our global, with other global exchanges, and it dual listed in London in May last year. But you can see the price performance has been really, really fantastic, and the recovery that we've seen is quite phenomenal. It's partly to do with gold prices, but also, we always say that the price performance is not just about the price of the underlying asset. It's also about how the company is managed, how well it's behaving as a public business, how it's interacting with shareholders, and that is actually quite core in our considerations. I wanted to talk also about ESG. I mentioned that last time I spoke at the previous MINEX forum, but I think it's really, really important to say that metals and mining industry is not outside the ESG realm. Environmental social governance is very much at the heart of everything that metals and mining companies, especially on the public markets, are now doing, especially the large one, but actually now is more and more widespread among the small, medium-sized and junior miners. So the quantum of the capital that is actually invested in ESG by investors globally is over 35 trillion. Across the globe, and growing at the rate of 14% a year, which means that it's not just about a lot of investors and marketers are concerned about greenwashing and so on. It's not about that. It's about very often the bottom line and the cost of capital to businesses. Because if you are not on the ESG track, then you might be actually left behind. So what it means for the businesses for the mining businesses. It means that there is a process of transition. So there is a big transition pathway initiative. There are, we at the London Stock Exchange have developed a suite of products that can be used, such as transition bonds, that can be used by energy producers, commodities producers, metals and miners, to actually signpost and commit to the transition to more sustainable practices. So, and we've spoken a lot about companies like Polymetal PLC that have that ESG. The ESG theme is a front and center and what they do, but also many other companies are now actually following them. So one of the things I just wanted to flag is one product is the Green Economy Mark. And that mark is now very popular. We launched it just a few months ago, and it is awarded to companies that, in line with the taxonomy of the FTSE Russell Green Investment, have more than 50% of revenue generated from the business activities that are green. So, and that's one of the examples of the things that public companies can do when on the market, to attract more investors, to diversify the investor base, and just have that in the times of crisis, have that reliable, diversified investor base who they can reach out to. And just to give you a little bit more numbers around that, so 79 companies are now have now been awarded with the Green Economy Mark, capitalized at over $75 billion US. It's a pretty substantial quantum. So I will pause here, and I'll just finalize just by saying is that in short, companies have continued tapping into capital markets to raise capital, to support their balance sheet, but also to invest in growth. Companies from the metals and mining sector, especially precious metals and gold, of course, are doing better, but we are seeing that other companies follow suit. And then the third pillar is ESG, and that businesses in this sector will stay behind if they do not follow the trend into the ESG, and they can do it through things like Transition Pathway Initiative. Thank you.
Thank you very much, Diana. Great job, and nice and brief. Now, I understand we're having problems contacting Graham, but we do have a recording that he made earlier, so we're going to play that now. So over to Graham Dallas.
Hello, everybody. I'm Graham Dallas. I work for the Toronto Stock Exchange. I'm based in London, and I'm in charge of international business development for the markets of Europe, Middle East, and Africa. And it's a great pleasure to be participating in the MINEX Forum for 2020. I'm going to talk about our markets. I'm going to talk about our markets specifically for mining companies, but I'm going to start by speaking a little bit about Canada, where the Toronto Stock Exchange is based. And really, the story I want to tell is one of financial stability and regulatory predictability. Canada offers an excellent base for financial markets, consistently voted the #1 G20 country for doing business. Canada has the lowest debt to GDP ratio amongst any of the G7 countries. And it's, again, consistently voted as having one of the soundest banking systems in the world. So it provides a very strong base from which to finance your business. The Toronto Stock Exchange and the TSX Venture Exchange, I'll give you a few key statistics. We have just over 3,200 listed issuers in total. Last year, in 2019, $39 billion was raised in new equity by those companies. And to put that into some sort of context, in the world of stock exchanges, we're number 3. So over the last 5 years, from 2015 to 2019, Canada, the Toronto Stock Exchange and the TSX Venture Exchange raised about $250 billion, which puts us 3rd in the world, behind the Chinese markets and behind the US markets, but firmly ahead of the markets of the London Stock Exchange and AIM, and also Australia. It's based in Canada, of course, the Toronto Stock Exchange and the Venture Exchange, but the people who trade and invest on that market come from all over the world. We've got institutions and investment banks from all over the Americas, from all over Europe and Asia. All the leading names are present in our market. So by being listed in Canada on the Toronto Stock Exchange, you have access to global investors and global providers of capital. We think that on average, about 40% of every day's trade on our markets comes from outside Canada, and about 25% of the people trading on our market are headquartered outside Canada. One of the reasons why we have success, I mentioned that Canada broadly offers a very stable and predictable platform. The TSX itself mirrors that. It's a very stable and predictable market for companies. The regime is pragmatic, practical, and really designed to support companies. One example of this is the way in which the likelihood of a class action by shareholders shareholders is really much, much lower in Canada than it is in the United States, for example. Liability is capped, and probably the easiest way to demonstrate that or to illustrate that is the fact that insurance for directors and officers of a company listed in Toronto is much, much cheaper than equivalent insurance for companies listed on the US markets. It's a more stable, lower risk, and lower cost listing regime. One of the things that's really unique about Canada is the structure that we have of a junior market and a senior market. The Toronto Stock Exchange is the senior market, and the TSX Venture Exchange is the junior market, and the relationship between the two is very, very successful. In 20 years, 679 junior companies have graduated from that junior platform onto the TSX. 19% of our blue chip index is made up of companies that began their lives on the TSX Venture Exchange. About 32% of the senior market is made up of companies that began on the Venture Exchange. And for the mining industry specifically, this is even more noticeable. 53% of all the TSX mining companies began their lives as mining companies on the junior market, the TSX Venture Exchange. Other stock exchanges offer a junior senior structure, but none of them is anywhere near as successful, as consistently successful in producing companies that go on to grow, to prosper, and become large companies, and in some cases to join blue chip indices. This is something unique to Canada. So that's something about the market in general. I'm going to talk now for 5 minutes very specifically about mining. Toronto is pivotal in the financing of mining companies all around the world. The Toronto Stock Exchange ecosystem supports 48% of all the global mining companies that are listed anywhere in the world. 48% of all the publicly listed mining companies in the world are listed in Toronto. We provide a great platform for these companies. They get excellent analyst coverage. We have over 200 mining analysts covering these companies, and there's a particular strength, I would say, in the sort of small and mid-sized segments of the market, where companies in Toronto get far better analyst coverage and investor attention than on equivalent companies, equivalent exchanges outside of Canada. Toronto really is the leading stock exchange for mining companies. We have 1,100 mining companies listed, or just over, which is more than almost twice as many as Australia, almost 10 times as many as London and AIM added together, and more than those two added together. And in terms, it's not just the number of companies, it's also the amount of money that those companies can raise. Again, over the last 5 years, 37% of all the money raised, equity, by publicly listed mining companies in the world was raised in Toronto. 37% in Toronto. That's a consistent year-on-year feature of our markets. And in fact, if you just look at last year, 2019 alone, in fact, that in 2019 our market share was up to 56%. But that was exceptional. Somewhere between 35 and 40% is what we do year on year. There is no other stock exchange that has anything like that financing capability for mining companies anywhere in the world. The mining sector in Toronto is very diverse. It doesn't really matter what you're mining. We have more gold mining companies than anything else, but the industrial metals are very well represented, as are things like diamonds, battery metals, industrial minerals, and of course uranium is also very important for us. And in terms of location of the projects, of where the mines and the sites are, again, it's all over the world. I'll come back to that in just a moment. But it's a very diverse market by geography and by commodity. I do want to emphasize just how strong Toronto is for mining companies, specifically for mining companies, compared to the other stock exchanges. So again, over the last 5 years, about $43.5 billion raised by mining companies in Toronto. As I said, that's 37% of all the money raised. And specifically, that is roughly as much as Australia, the New York market, the Hong Kong Stock Exchange, the London Stock Exchange, and AIM, all added together, is about the same as what was raised in Toronto. So Toronto is the place to raise dollars for your company in the mining sector. It is a global mining market. Toronto, half of our companies are their projects are in Canada, but 47% of the projects, that's over 2,500 projects, are financed by companies in Toronto, and with the projects being outside Toronto. So in Europe, for example, we've got 23 listed issuers working on 50. We've got 23 listed issuers on the TSX and another 50 on the venture exchange. So over 70 issuers working in Europe, another 13 issuers working in Russia and the former Soviet Union, companies like Lydian, Centera, and so forth. So it's very much a global market for companies and projects all over the world. Drilling down into who those issuers are, so we've got about 1,100 mining companies. 900 or something just over 900 of those are listed on the venture exchange. They're junior companies, and they've got an aggregate mining cap of $19 billion. 200 odd companies listed on the TSX, but with an aggregate market cap of over $360 billion. So you can see the venture exchange is for junior companies, much smaller companies on average. We welcome the concept of companies being listed on more than one stock exchange. So we have over 120 companies that have dual listings, whether that's in London, in Australia, in New York, in some cases in Latin America and around the world. So dual listing is very much a part of our business that's known, understood, welcomed, and non-problematic. And just to drive home the relative position of the TSX and the TSX Venture Exchange one more time compared to these others, you look at it by number of companies listed, by the amount of money raised over 5 years, 1 year. I mean, last year, for example, our mining companies raised $12.5 billion, far more than all the other significant mining exchanges added together. The market cap is actually a little small, is not the biggest on the Toronto for the mining companies. We have our market, the aggregate market cap of our listed mining issuers is about $380 billion, which is less than the ASX or the New York Stock Exchange. But that's really because they have a number of the very large, the sort of super major mining companies congregate there. I think it's fair to say that Toronto's strength really is in the sort of intermediate size, the small and the mid-sized companies, where we really offer a platform that's tailored to their needs, particularly in terms of listing for the first time and raising money. And just look at the number of listings last year. It wasn't our best year by some measure, but there were 29 new mining companies listed in Canada, compared to what, about less than 20 on the other major exchanges added together. So it's really a very important market. There isn't another market as important for mining companies. Leave you with this: the advantage that the TSX and the Venture Exchange offer. Really, number one is that we have the leadership position in mining. If you're in the mining industry, you need to think about Canada. We offer a flexible route to market, access to investors all across North America and indeed around the world, and a number of flexible structures that make life easier for issuers to raise money quickly and cost effectively. The market's busy, the bankers are busy, there's growing interest. There's been a lot of M&A activity. There's been increasing new issuance. I'd say that explorers are once again being financed. The mining sector in Canada on the TSX and the TSX Venture Exchange is in excellent shape. And I look forward to talking to some of you. I hope the conference is valuable, useful, and enjoyable. Thank you.
Thank you very much, Virtual Graham. I understand Graham has managed to join us now, so he will be able to take part in the questions. So we have a couple of additional people joining us for the questions, and I'd like them to give them a couple of minutes to talk about their perspective on the world before we move into the questions. So I'm very pleased we've got Angelos Damascus, who works for Sector Invest. So if Angelos is there, if you'd like to spend a couple of minutes talking about what you do and your view of the market.
Yes, thank you, Ross. As you mentioned, I head Sector Investment Managers, which is a resources-focused investment management firm, and we specialize, we rather invest across the board of natural resources projects, but we have a particular specialization and expertise in precious metals. And we have been running strategies in that field for over 10 years now in the public markets, but we have also been operating under private equity guises under various structures for over 20 years. So we have a long experience looking at mining projects around the world. Our main focuses are basically avoid early stage exploration risk. We don't like to back companies that are just exploring on the surface and don't have resources yet to show, because that doesn't enable us to put a value on the size of the resources and the economic viability going forward. So we'd like to see some reserves in the ground, but also the quality of the management team, the track record, and their expertise, not only in the resource specialization, but more importantly in the region of operations, is particularly important. So we like to follow teams that have been successful and have the credentials and the backing to succeed again.
Great. Okay, Angelos,
Sure.
I know that you have a lot of interest in gold. So did you share Florian's views on the gold market?
Well, certainly. We have been focusing in gold as a store of value and a safe haven asset from 2002, 2003, pretty much at the turn of this sort of longer term bull market developing. And we have been investing in a number of companies, in the process. Now, in terms of Florian's position as to the current macroeconomic environment, I fully agree with it. And I think that to summarize our position is that what is happening now in the world with this dreadful pandemic is something that was totally unexpected, is something of unprecedented proportions, and it's damaging. It is extremely damaging for the economy. At the last count, we added up that the total government intervention and central bank intervention around the world is in excess of $13 trillion. Much of that financing goes to support people who have been furloughed or have been made unemployed, to support companies that are on the brink of bankruptcy because they have seen their trading disappear, are not able to trade at all, or have seen a damaging change in their cost structure. So effectively, my outlook is that however the world deals with this pandemic, we are grinding into a very, very deep recession. It's going to last for quite a while until we sort out the distribution chains, we sort out the way people work and the way we deal with the new reality. And in the meantime, much of that bailout program, the 13 trillion I mentioned, is effectively life support, i.e. is not invested in productive capacity. So we are going to be facing a deep recession. As we try to exit it, we are using a reduced output capacity. Many companies are going bankrupt, so the productive capacity of the world is greatly reduced. And we will be trying to repay this huge new debt load with a lower productive capacity. So unquestionably, in my mind, this will result into a debasing of the leading currencies. It will result to more rapid inflation because the cost structures have changed across the world and across every industry. And therefore, both of these scenarios are very supportive for safe haven assets, particularly precious metals. So it's not that gold and silver, for example, are dancing on the world's misfortune. It is just that they are fulfilling their role as a safe haven asset and a store of value. And this is why investors around the world are increasing their allocation to the precious metal. We have seen a hyperbolic rise in ETF holdings that are backed by gold bullion. And this is effectively backing the rise in the gold price as we have a certain finite supply. So concomitant to that, as we see a rise in the metal prices, that has a transformational effect on the mining companies of the precious metals, particularly those companies that have a relatively higher marginal operating cost structure. So as you can imagine, if you think that a company is operating with $1,000 per ounce all-in cost and is selling at, say, $1,350 output, of a gold sales price, it is making $350 profit. Now, as the current price is near 1,700 or just above it, the actual margin has doubled. So the impact on the valuation of the mining companies can be tremendous. And many companies, most companies rather, are making very, very strong free cash flows and are adding to their cash positions. So their multiples are becoming much more attractive. So it's a very, very attractive area of the market to invest in. And we think as we see the precious metal prices going higher, the valuations of the mining companies are going to re-rate substantially.
Yeah, very good. Yes, thank you. Now, Rama, do you want to try and talk to us again?
Hi. Can you hear me now? Or
yes, great.
Oh, sorry about that. So yeah, I mean, you wanted for us to give you a quick brief about MMG Capital and our view on the market in a couple of minutes. Basically, MMG Capital, we invest in mining companies and then we help them on corporate finance issues, raising equity, debt, and M&A, joint ventures, strategic partnerships. We exclusively focus in the metals and mining sector and also steel sector. The way we have a portfolio of projects around the world, from Brazil to Finland to North America, Europe, and Africa. And usually they are in the junior mining space. So in terms of the markets, the way we see it very much is that it's almost like a trifurcation between the majors, the companies that are between 50 and $200 million market cap, and then the really junior mining space who are less than 50 million. The funding availability to these three categories are completely different. The majors who have strong balance sheet and liquidity and so on have access to the market. Their stock price hasn't really been impacted that much by COVID, and they are well diversified geographically or across metals. So we haven't seen any diminishing situation with them. The second category are the 50 million and up, and usually that's when the 50 million is like almost a minimum threshold in terms of market cap, where we have funds and more institutional players coming to the companies. So we heard earlier about Adriatic and Pure Gold. Their market caps when they listed were 100, 200 million. And that's when you get these institutionals come in. When you have market caps of 20 million, 10 million or less, there are only very few institutional investors that would come in because of liquidity issues and percentage of shareholding. So the The third category are the junior mining companies, which are like anywhere between 1 to 30, 40, 50 million. And often they have core shareholder base of 50 to 70, 80%. So the free float is very small, the liquidity is very small, and they have a more challenging, challenge in terms of raising money from new investors. The ones that have strong shareholder base who support them, they usually act as like an ATM machine and provide them with the cash to move them down the stages. So we do see a lot of placements successfully completing with existing shareholders, even with this group. The last thing I want to say about them is that the raising money for this junior mining space, which is probably of interest to a number of people participating at this conference, depends a lot also on I would say 4 or 5 things. One is the time to a major milestone and whether they are funded to that milestone. The big milestones are PEA, BFS, construction, and production. The second is the cash position and their burn rate. If they're basically have less than $100,000 and their burn rate is 30 to 50,000 a month, it's going to be very difficult to raise money. So they should be really forward-looking when they're looking at their funding situation. And then the terms of the offering in terms of placement plays a crucial role, whether the placement is in the end successful or not. I'll stop there and then we can discuss during Q&A.
Yeah, great. Well, I don't think we've got a lot of time for Q&A because we're already right, but we'll hopefully have a couple of questions. So I have one question here. So this is something that there's something that touched on by Hugh earlier, and he didn't really make a lot of difference to him. But how are investors responding to a world where they're unable to visit projects and meet the management team in person? Is this affecting the diligence process and the ability to invest money? So what about Angelos? Do you want to go first on that one?
Yeah, sure. Well, I think generally speaking, the COVID situation hasn't affected the smaller companies that badly because at least those who are at the pre-production stage, because the major impact to most of them has been the suspension of the drilling activity. So they already have their inventory of drilling results to talk about, they have the resource estimates to talk about, and they can still meet in virtual conference calls with investors and potential financiers. I think the bigger impact has taken place in some of the operating companies who have production in areas that have been affected by COVID-19. For example, Mexico has been affected really badly. Everybody has had to suspend operations and certain other areas in the world. It has been most detrimental to those companies that are at the late stage development program, where they are trying to raise financing to build a project, for example. And at that stage, bankers, financiers, mezzanine capital providers, equity investors, they all need to send their specialists to do site visits. So as long as the people, the personnel has not been able to access the site because of COVID-19, all the due diligence process has been suspended and the sign-offs, and therefore the financing is not available. So there is valuable time lost in that particular segment of the industry where they are trying to put a project into production. But otherwise, we see now a gradual restart of operations around the world. Some of the movement restrictions for personnel have been relaxed. Companies are taking much more active and dynamic management of the testing and regulating people's movement from site to their home place, etc. Some sort of normality is coming back, and I think it would be fair to say that the mining world has been affected much less than many other industrial sectors of the economy, because most mines operate in very remote locations. It's much easier to ring fence operations. It's much easier to check personnel coming in and out of the site and to isolate cases of infection. So it is an industry that I expect will bounce back much quicker than anything else as we come out of this emergency infection rates of the pandemic.
Great. And what about Iuna? Have you been seeing an impact with stock listed companies, with investors?
Yes. It is actually a fantastic question. It is exactly what both investors and companies have been looking at ever since the breakout of the pandemic. So I'll give you one example. For example, if a mining company, wants to go public, and they need to raise capital, they need to do a roadshow. So typically in the pre-COVID-19 world, they will go on a roadshow, meet face-to-face about 100 investors around the world, London, Frankfurt, Hong Kong, and so on and so forth. But now what they're doing is they're doing this virtually. So both companies that are already listed that want to raise capital and the pre-IPO companies, they are trying and testing doing this via Zoom or Skype, and it is working. So there is, you have seen the media reports. There is one major business from China is coming to list in London. Then a number of others are on the road that are doing this virtually. So in terms of the visiting the sites, then I would refer that to the experts. But I think in a socially distanced way, that might be possible.
Great, thank you. Yeah. And I think we're going to swap your image and put in Graham just to prove that he has actually joined us. And we have another question, which is we've been seeing lots of equity raisings, particularly for gold companies. Is it possible to raise equity capital for other commodities at the moment? And as follow-on question, what about the region? Is it easy to raise money for places like Kosovo and Serbia at the moment, or are people only interested in Australia and Canada? So I'm going to ask Graham. I don't know if we can see him.
No, can you see me? Can you hear me at least?
Yeah, we can hear you, definitely. So if you want to
hear me? Okay, good. Well, I'm sorry about earlier. I can only apologise for my clunky handling of the technology. Yeah, there's been very good activity in raising money for juniors. It's for gold juniors. It's frankly it is harder for other commodities, but not impossible. I mean, in Toronto so far this year, there's been 380 odd financings and over $1 billion, $1.2 billion raised for mining companies, most of it for gold, but by no means all of it. We did some things to make life a bit easier for the juniors. The ambassador referred to some of that earlier today. About giving people some relief in filing dates and so forth. When it comes to jurisdictions, I think for some years now there has been a trend towards the safer jurisdictions. People like North America, they like certain parts of South and Central America, but I think Europe generally is, every project is specific, but I think European jurisdictions are accepted, and it is possible to raise money for them there. And we've got over 70 companies listed that have raised money there. So I don't think the jurisdiction, unless it's something really high risk. Hugh, I think, mentioned earlier that they're not financing in Russia. I mean, we don't have rules that say that. We follow what the market demands, but European jurisdictions are by no means off the agenda at the moment.
Okay, great. And I wanted to bring in Rama and get his views on that. What do you think about other than gold and where investors are looking?
Yeah, I would largely agree to that. There's obviously enthusiasm about gold, and to some extent silver, but I would say that it depends on the investor category. I think in the retail, high net worth individuals and some funds, they are now very much precious metals oriented, and because of the expected growth rates and the impact of COVID, and especially in the near term, they are less enthusiastic about base metals unless the project has an amazingly low cash cost or is in the tier one category or something very special about them. But having said that, there are other groups of investors that are actively looking at these projects. I'm talking about especially copper, and to some extent lead and zinc and nickel as well. And they're the trading houses that provide financing for offtake. From the time you have a feasibility study onwards, they will be interested to finance the construction and to some extent also finance the feasibility study for the offtake. And then the PE funds that specialize in mining, who are also quite active in this, they do look at the cash costs very carefully in these days. They have much lower price decks in terms of forward-looking when they're looking at the models, the PEA model and so on. So their sensitivity analysis is much stricter than probably the mining company itself, but they're very much looking at it. So I think besides the precious metals, the other investors, as well as more strategic investors like other mining companies, are in this base metals and other metal spaces.
Okay, great. Moving on to a different question. We saw the proposed takeover of Tethian Resources by Adriatic. So do you think the share price drop that COVID has brought will lead to more M&A in the region?
Can I respond to that?
Yeah, has someone got, yeah, Angelos?
Yeah. Well, we saw a dramatic volatility, phase of volatility, particularly during the month of March in all equities as the equity markets corrected dramatically and quickly, and that was primarily liquidity driven. And as you can appreciate, mining companies being less liquid and less actively traded in the marketplace, when investors have to liquidate and access cash and sell across the board, and they try to access cash from the less liquid companies, that impacts the valuation dramatically. So there was a very sharp and protracted move of the mining segment, the mining equities as a whole, down. But in precious metals in particular, precious metal miners have recovered very, very quickly in the next couple of months to date. So we have seen a very good recovery, and in some cases, shares are trading well above the levels seen before the crisis, the pandemic. In terms of the M&A activity, I believe that it is not only related to the share price of the companies. It is well understood that the major integrated mining companies and even some of the larger mid-tier producers are seeing a gradual depletion of their reserves, i.e. they produce more than they discover. And also their average grades across the portfolio of assets has been dropping. And that is a result of focusing on existing operations, focusing on improving the operating cost structure, therefore targeting the higher grade areas of their portfolio, and neglecting funding exploration and development of new areas and new projects. So with the very rapid and sharp rise of precious metal prices, most management teams are now thinking about growth, and they are thinking how to replenish the gold that they are producing and how to feed into the longer term development of the company. And the easiest way to do that is by acquiring a project that is already discovered, where you can assess the resources, that is relatively easy to assess the timeline to production and put a value on that particular project. So we see a very significant increase in takeover activity, and I think it can only intensify. Because every single company is now looking at their growth prospects and the growth portfolio and are trying to address it. So the smaller companies are really the sweet spot here, because they are the companies that control typically late stage development projects that can come to production fairly quickly. And therefore their valuations are going to re-rate as investors realize this opportunity.
Ros, if I may, I'd like to build a little bit. I completely agree with what Angelos has just said. I think there's another factor at play here, which is that there's kind of a gap in the market for, let's say, significant intermediate size players and producers in the precious metal space. And as we've seen the price of gold move up very strongly recently, partly it was happening before the COVID crisis. It certainly happened in response to the government funding that's been poured into economies around the world. There's a shortage of ways for generalist professional fund managers to invest in gold. It's very, very hard for them to invest in juniors. The stocks, frankly, aren't liquid or large enough. They're already fully invested in the big index stocks, the big super majors, the Rios, the BHPs, and so forth. So I think there's a move to create a new investable tier of mid-size players. We've seen a couple of things happening already. There was just as the crisis started to hit, there was the endeavour with Semafo joining to make the largest West African gold producer. There's been a couple of other transactions since then. There's SSR and Alasa in Latin America, and Gran Colombia, who have done a sort of a three-way deal with Guyana Goldfields and Gold X. And there's other things being talked about as well. So I think we're going to see
Perseus today, I think, wasn't there? Perseus.
Right. Yes. I think this is a trend. There is room for investable mid-size, late-stage developers and producers that can give a wider range of fund managers a way into this market.
Brilliant. Now we're going to have to draw to a close, and so Iuna opened her mouth. Do you have a last word before I thank all the panelists?
Just last word, just to underline that every time when there is a crisis, and we saw that post 2008 financial crisis, it is an opportunity for a heightened M&A activity, and it's a trend, and that does happen, but it doesn't mean that it's a bad thing. It means that there is a consolidation, and companies sometimes just pool resources and just make the industry stronger. So that's a small comment that I wanted to add.
Fantastic. A great note to finish on. So I'd like to thank all the panelists. For me, it's been a fascinating panel, and I hope everyone out there enjoyed it. And back over to Arthur.